Hey YouTube, it's Dimitri, and today we are going to talk about consumer credit, which is more or less just loans. That's what we're going to be talking about a little bit here. These are just the basics. So I just want to lay the foundation for understanding consumer credit. This sounds like this really boring area. I know when I was in grad school for quantitative finance, this was the area I didn't want to end up in, and yet I knew absolutely nothing about this. And magically, I have fallen into this career path of doing consumer credit over the years. And this is on the sell side, so this isn't the fun and exciting hedge funds. And yet there is a ton of math and modeling going on this side, and yet it does not get enough attention. So I figured we would go through the basics here, talk a little bit about loans, a little bit of the characteristics here, more or less a traditional finance perspective of this, of the loans, and then going back and looking at some of the complexities here at the end, so you can kind of get a little bit of an idea of what we're trying to solve more from the quantitative side of this. So first off, loans are just fixed income. So I know in grad school, in textbooks you read, most of these things start coming off as fixed income, and then they start to go into like bonds and, like, I don't know, even like fixed income derivative products and corporate loans and looking at firm structure. And they completely ignore the fact that there's this entire industry, which is much, much larger in many cases, of the consumer side, because there are a lot of consumers here. And there's a lot of data on this side, which is why it's actually a really interesting area to be in, because we can actually use machine learning, and we've been using it for years now. Because there's so much data, we can actually do cool things with it and make machine learning work here. There's really two types of loans here. There is simple interest and there is compounding interest. Everything I learned in school with finance major was compounding interest. There was not a lot of emphasis on simple interest here. And you'll see as I talk a little bit about this, a lot of the traditional finance ideas I kind of just throw out the window from a quant perspective, because at the end of the day, we can go back and we can do really simple discounting of cash flows and simple, like, I don't know, IRRs and NPVs. At the very end of all this, like, that's the easy part. You'll see here, predictions and things is the challenging part. But I'm going to cover some of these little basics here just so you understand some of the differences in loans, because I work in the auto industry for some time now, worked in mortgage as well. But simple interest is very common in the auto industry side. And cash flows is going to be kind of the thing that we're looking at here. So cash flows look the exact same on these different types of products, right? If it's a bond, if it's a simple interest loan here, or compounding interest loan, like any type of fixed income product is called fixed income because there's going to be fixed payments. So down here is an example on the bottom, just showing you, let's say this is 12 months. You're going to get $250 for all these payments. Every month you get $250, right? So if you're a bank, you're getting the $250. If you're the consumer, you might be paying $250 every month for your house, for your car, for, I don't know, personal loan, some type of loan here. It's going to be a fixed amount, which is why it's called fixed income. Okay, and there are two types of interest here. So we're going to say types of loans are not really types of loans, because loans don't really work this way, but I want to cover this because we're in fixed income. And the original version of this video, I screwed up, and one of my colleagues, so thank you, Jessica, showed me that I screwed this up. So I have not done this in a very, very long time. It's been almost, I think, 20 years. But there are simple interest loans, which is going to be your standard loan calculation. So you can think about auto loans, mortgages, those sorts of products here. You're going to calculate out your payment, which is going to be this crazy formula on the screen here. And the way these work is that you're going to have a principal balance, which is going to be the beginning loan amount here. You're going to calculate out your payment here. So I have $450 listed on the bottom. That's going to be your payment. And then the way that you actually calculate out the interest is going to be that starting principal balance you had here. So say $20,000, which is the amount you start with the vehicle. You times that by the interest rate, which is 12.5%. And you multiply that by the years. So what I mean by this is that we're going to convert the interest rate into monthly terms, because that's typically how these loans are paid out. And the way we do that is we take more or less the interest rate and divide it by 12. Years here can be just time, better way to put it here. But really what this equation would be is just 20,000 times 12.5 divided by 12, because there's going to be 12 months and this is an annual rate here. And you're going to multiply that out, and that's going to give you your interest payment for the first month. And if my math is correct here, I remember it's like $208.33, 34 cents, something around there. But basically you have a $208 payment, which is going to be the interest portion here. Now, the way that we back out how much principal comes off this loan is you're going to take your full payment amount of $450 and you're going to minus off that 208, and that will give you around $241, $241.67, something around there. And that will be your principal that's actually reduced on the loan. Now, it is very confusing reading these online because they say that your interest is always calculated off the original principal amount. This isn't really true. You need an amortization table. So now that we've done the first month transaction, what you end up actually doing for the calculation is in the second month, you take your original principal amount, which was $20,000, and you minus your $241, and you'll end up with a new principal balance for the next second month here, which is going to be $19,758 and like 34 cents here. And that's going to be your next new principal amount. So we'll do the exact same thing here again. We'll do that 12.5%. We'll divide that by 12 months since we're converting into a monthly rate here. And we'll multiply that by that new principal balance that we have adjusted now, which is going to be $19,758.33. And that will give us now a new interest payment of $205.81 here. And so then again, we'll go back into the principal piece here and we'll do, $450 minus that 208, and now we have another $244 being applied to that principal on the second month. And so then you iterate through this, and if you have your loan set up here the way I do for 5 years, which is 60 months, we do it 60 times. At the very end of this, your remaining principal balance will be zero. Now, there gets complications and somebody decides, you know what, I'm not going to make a payment. And so now you owe me interest on the time that has passed. So if you skip a month, now you have to owe me double on that. It screws up with the timing, and then you won't end up balancing out perfectly. Also, those little good doers, out there, such as myself, who decide to pay extra on that loan. Now it makes it extremely more complex in the sense that now that loan's going to finish early, but then you have to adjust, again, your amortization table here, which is probably the easiest way to do this and visualize it. So this is what a typical loan looks like. This is what auto loans look like. This is what mortgages look like. And this is just simple interest. So this is basically all loan products that we get here in the United States, at least. Now, I wanted to point out the compounding interest piece because these things always confused me in school in the sense that they would teach compounding interest and then they would tell you there was loans and then we would do simple interest, and they never really told us these were simple interest. And since I don't do this on a daily basis, I never really cleared these ideas up too much. And so I think it's important to kind of point these out. Compounding interest is more or less like investment products here. So high yield savings accounts, money markets, CDs, bonds, mutual funds, REITs. But the way these work is that when we do that amortization table, instead of us taking that interest rate times our time piece here, or that division piece, so this could be a division sign as well up here instead of a multiplication sign, but we would take like that 12.5% and we would divide it by 12 to get the monthly interest rate. Now, instead of multiplying by just the principal, we compound the interest on top of that principal. Now, I think this is a very, very odd and weird way to think about a loan because these really aren't loan products, even though a bank is kind of on the flip side of this. But if you think about like high yield savings account, imagine that you are going to have in there, I don't know, let's say $20,000 again, just to make this easy. And you get, let's say, I don't know, 5% per month here, which is really high, but we're just going to do this to make it simple. You're going to get $1,000 of interest. Okay. Now, the reason this is different is now that interest gets compounded on top of the principal. So the new balance starting next month now is going to be $21,000. And now you're going to pay out you're going to pay interest out on that 21,000. So instead of 20,000, you're going to do interest calculation off of 21,000. And now the next month, the interest that you owe is going to be 1,050. So you see here, it compounds, and the further out of time you go, the worse it gets. The reason being, and the difference between simple and compounding interest is simple interest is you always calculate the interest based off of the principal or the balance on that loan, and it decreases across time here. Now, compounding interest, the way it's working is that you're calculating that off of the principal and the accrued interest together. So the amount of interest is always higher because you're calculating your interest payment, or your part of your interest here in your payment, based off of your principal and your interest from that period here. So again, these are easier, I think, to understand from a high yield savings account, like it going up in value, because that's typically how we do these. Again, you can look at other types of products as well and kind of visualize those things out. But the last chart I had on the last presentation, I screwed up. So this is being all replaced here. I had simple interest and compounding interest, and it's hard to visualize them, which I'm going to show you here in a second why they're unique. But I think it's important to take a look at how this plays out here. So on standard loans, mortgages, car loans, and all that, you're going to pay the most interest you are ever going to pay on the loan at the beginning, and that interest gets smaller and smaller and smaller towards the end, because again, that interest is calculated off the balance. And as the balance decreases across time, we pay less and less interest here. Now, I know people have shown me charts. You typically have a line that starts up on the top left or whatever, and it slopes downwards, a similar curve, and it crashes to zero, which is your UPB, unpaid balance. This is just the standard chart that you'll see in like a finance class, which just shows the breakout of interest and principal here. And that's how these payments are actually allocated across time, given you make all your payments on time, not early, not late. And this is the chart I really wanted to just kind of explain and show a little bit here, which I failed to do in the original version of this video. The future value, which is going to be, the value of this product as it goes across time. We can view this more or less as the amount of interest that we pay across time. They are the exact same in the first period. And then after the first period, the compounding interest here, the yellow line, will actually be higher, because it's compounding now that interest calculation, so that interest rate that we're multiplying by the previous interest and principal combined together. So that remaining balance plus that interest together. And so over time, the balance is going to be increasing much faster than it would on a simple interest loan here. So this is just the point I wanted to make here. There's a difference between compounding interest and simple interest. So that simple interest accumulates across time as well, as we see here. But compounding interest, which is, again, compounding interest on top of interest here, as they say, is compounding even faster because of that. And so eventually over time, it will spread. There'll be a large difference in the amount of actual value or payments that you actually pay because interest is growing so fast. Now, let's look at the risk of this here. So this is where risk management comes in. Anything that you see that says quantitative finance, just replace that fancy word here with risk. That's all we're doing here, right? When you think of financial engineering, quantitative finance, you think of derivative products, right? Financial engineering, that's what most of us think. Financial engineering or derivative products are designed to reduce risk. Quantitative finance as a whole, when we look at loans, is how do we reduce and manage risk? That's what quantitative finance is applying mathematics and statistics to a financial problem here. That's the quantitative piece of this. At the end of the day, we're just managing risk, because risk and return are kind of the things that we're balancing here. So the higher the risk, we expect a higher return. The lower the risk, the lower the return. And you can flip that logic around here. It still applies. But what can go wrong with the loan, right, Dimitri? It's a fixed product. They're going to make all these payments, and we're just going to collect all of our cash. This is super boring. Well, the issue is many people don't actually make all their payments. So default is probably the number one risk with loans here. Now you start to get into the detailed issues with default, which is going to be, when do they default? If you default in like the first, let's say 2 or 3 months, I'm going to lose a lot of money as a bank making that loan to someone. Even if you think about this in accounting terms, if I just want to get my money back, there's going to be a break-even point in these loans where you're going to have to collect enough payments just to cover the $20,000 in that loan, just to be made whole again. And again, this happens towards the end of the loans here. So timing of the default is absolutely critical, because those that default at the end of the loan might not be the end of the world, right? You get your money back, maybe you make a little bit of extra money. We kind of wash our hands of it and we all move on. But often when you have a lot of defaults towards the beginning of these loans, we're going to be losing a ton of money here. And so, as we'll see here in a second with some of the complexities, you have to figure out how to adjust, different sorts of pricing and rates to be able to get to a profitable state, or how do you completely avoid these risks altogether? Now, the other issue too with a lot of loans is whether it's asset backed or not. And this is where we start talking about conversations around like student loans versus like auto loans versus mortgages. Loans that have an asset at the the back end of it means I can liquidate that asset to get some sort of cash back out of the deal here. So you think about like this auto loan we had, you think about it's a $20,000 loan. The customer makes, I don't know, 3 or 4 payments, then they default on the loan. I can sell that car because that consumer owes the bank money back. And so the bank can be made whole in the sense that they can liquidate that vehicle and they can make themselves whole. Now, again, extra cash would go back to the customer if there was extra cash to be had from this sort of sale here. But assets that are going to be able to be sold makes this loan much safer than things like a student loan or unbacked loan here, in the sense that what's going to happen is, let's say you go to college and you do 2 years in and you rack up, I don't know, $20,000 in debt, and then you default. Right, like the bank can't go and say, hey, give me your college degree, because one, you didn't even complete the degree, right? Only there for 2 years. And even if you completed the degree and then you default on the loan, the bank can't sell anything to get made whole again. And this is where you start to look at things that are, loans that are not asset backed are going to be much riskier, in the sense that there's no way to collect on the asset or whatever that loan is actually intended for here. So that's a key risk piece here. And that's how many banks, don't want to do student loans and sorts of loans like that are unbacked, because if they're not going to be backed, you increase your risk significantly here. The other piece to consider here with asset backed is thinking about depreciation rates. So different cars, vehicles, houses, things depreciate at different rates. I mean, like, say you buy like a motocross bike, because I raced motocross for a while, right? The value goes from really high to really low within like a couple months here. It's just not worth much. That depreciation that's too fast, those assets are even riskier, because if someone defaults towards the beginning of the loan, which is the riskier piece of this, you're going to not be able to be made whole even after selling that asset here. So depreciation is a huge piece and a big piece of the modeling for figuring out if these loans are going to be safe enough for a bank or an institution to make here. The other piece is timeline commitment. So I don't think a lot of people realize this. I see a lot of the machine learning community thinking, you can just throw a bunch of stuff in here and you can make decisions, and this is all going to be fine and dandy. The issue here, though, is that you cannot learn from a model. So a model cannot learn in the sense of loans often, because what happens is there's a time commitment. You make that loan today. So say it's a 5-year auto loan. Even if I know that loan's bad in 6 months, right? I already made the loan. I can't get my money back. I can't go back to the customer and say, hey, I decided this is too risky. Can you just give me back the money? Like, that's not how this works. So once you make these decisions, and you think about mortgages, for example, 20, 30-year mortgage, you're locked in for 20 to 30 years, whatever the terms are on that loan here. Now, there are ways to get out of these. People are smart, though. Banks are smart. They're not easy to exit here. One, you can buy derivatives to help kind of hedge risk. Again, those are expensive. You lose the cost of the derivative. You start weighing the pros and cons here. Again, consumer products, there's usually not as many derivatives that are going to be able to hedge towards a specific consumer. So you're not going to have something that's really specific to, some specific type of consumer here. Now, you can try to find derivative products that are linked to like interest rates and things like that to hedge those sorts of risks. But that's not going to be consumer specific here. There's a whole thing on that, a whole analysis in that piece. The other issue is securitization, which is more or less like you sell the loan somehow, right? You can privatize and sell it to someone else. You can do a securitization where you actually just lump a bunch of loans all together into a big pool, and then you sell it off to another firm. But the reality is, firms aren't dumb. So when you have a bunch of garbage loans, no one's going to like jump up and pay you a bunch of money for it. You might be able to exit if you've made some not so good loans and you need to get out for some reason quickly. They might be able to say, hey, it's not worth what you think it's worth. So say 100% on the dollar here, it's only going to be worth 40 cents on the dollar. So I'm only going to pay you 40 cents of the actual value of like the principal, for example. And then you can walk away, but I'm going to get that, that portfolio for 40 cents. Now, there are reasons why you might want to do that. Again, if you make a bunch of bad loans, you're kind of screwed. Often you're going to just write off all these loans because no one else is going to be dumb enough to take a bad position here. The other issue too is you're waiting for cash to come in the door. So let's say, you have, $1 billion, which isn't really that much in the banking side, and you take $1 billion and you make a bunch of loans and you make all these really, really good loans and you're really smart and your models tell you exactly what to do. Now you're stuck waiting for that cash to come back because all those loans went out. If they're 5-10-year loans or something, right, it's going to take you 5 years to recover that payment. And maybe it takes you, I don't know, 4.5 years to recover, the principal amount of that loan. Let's pretend they all make their payments and everything. You're going to do that, but you have to wait to get all that cash back so that you can use that cash to make more loans here. So getting that volume piece is critical here. Now, what firms do and banks do, large financial institutions, they'll take a bunch of cash, they'll generate a bunch of loans, they'll pool it all together, they'll securitize it, and then they'll sell it off to other banks. Now, this is really smart for diversification here. So we talk about diversification investing, stocks and all that, bonds. But in the product world, in the sell side, and even for like hedge funds, for example, if you want to diversify into like consumer credit, you're not going to go out there and hire a bunch of people to service these loans, which is a whole other issue here. So collecting payments and, doing paperwork and legal things and moving titles around, and it's a whole bunch of this stuff. But they don't want to do that. And even if a bank specializes, often they'll specialize in something like maybe like prime or super prime, but they want exposure to subprime, but they don't want to bring in a whole bunch of quants to build a bunch of models and then do all this extra work to generate a bunch of loans. So what they'll do is if they're a prime bank, they'll go out and they'll find subprime loans from another bank that specializes in subprime. And often the banks will kind of swap and they'll purchase different types of portfolios to help diversify their consumer risk exposure here. So securitization is critical on the banking side or the sell side here. Again, you need models to securitize to figure out what things are worth and their valuations. And then there are rating agencies that go through this as well. Again, there's more and more models and math and finance behind the scenes that do this. But timeline commitment is critical in loans. Like you can't just buy and sell. This isn't like stocks where you can say, I'm going to buy Tesla today. And then in 5 seconds, I decide it's a horrible deal and I sell it and get out and I only lose a few pennies or I make a few pennies or something. Loans don't work like that. Loans are long-term. So once you make a decision, once you execute, there's usually not a quick and easy way to get out of these things. And so it takes time to move a lot of this paper if you need to get it off your books. So again, modeling here is absolutely critical. One of the most common approaches that everyone uses is going to be called expected loss here. Now, this has changed over the years. I believe it was called ALLL when I started my career, which is allowance for losses, leases, and something else. It's been way too long. It's almost been a decade here. But now it's been replaced with what we call expected loss. So expected loss is going to be PD times LGD times EAD. So this is probability of default, which is a percentage, times loss given default, which is a percentage, times exposure at default here. So I view this really as two big parts. Probability of default is what is the likelihood this customer is going to default over the life of the loan. Okay, that's just a piece. Now, loss given default and exposure at default, I view as one chunk, one component here. We typically model them separately though. So exposure at default is, let's say, the customer defaults at some point. There's an exposure at default. That's the unpaid balance piece here, the loan that's going to be outstanding. So if you had a $20,000 loan, they paid off, $15,000 of the principal. There's $5,000 left. The exposure at default is going to be $5,000. Now, we don't always collect the $5,000, right? You might sell the vehicle to get proceeds here. So this is called a recovery. So you go out, we do a repo. So there's whole models on repossessions. But you go out, you do a repo, you get the vehicle back, hopefully, and then you sell it at auction and you hopefully are made whole. But a lot of times you are not made whole, and it's a fractional component of what you can actually collect here. Now, what the middle class and upper class in the quant finance space doesn't understand is that, even in middle class, like when you don't have the money to pay for something, you don't have the money. And I don't understand why people don't get this. I guess because you've never been in that situation. Your parents have never been in that situation. But when consumers don't have money, they don't have money. There's no way to collect from them. They don't have any money left. All their money is going to pay for food and rent. They don't have money to pay off these loans. So when they default on this, you're only going to be able to collect a percentage sometimes. Sometimes you'll get nothing. Maybe the car was wrecked. Maybe the car was lost. Again, technology for GPS tracking has gotten much better, but loss given default is going to be the percentage of that actual recovery piece here, that capital at the end of it that we're actually going to collect here. Now, sometimes you even might collect just some extra payments. Like maybe the customer says, I can't pay it. I'm not going to pay it. And then it gets sent to collections and they sell off the loan. then you get paid out a small fee maybe for selling that loan off to collection. So you might only collect, 5%, because that might be what the collection agency gives you is 5% for the loan. So 5 cents on the dollar. And then they go out and they try to do the collections. Sometimes customers, they're like, hey, I can't do this. I can't make the payments. I already defaulted. I haven't made payments in months. They'll actually return the asset, the car or the house or whatever, to the bank and say, I'm done with it. I don't want anything to do with this. And they might make a few extra payments just to kind of catch up to where they should have been, because they don't want to destroy their credit and they don't want it reported. And so they're trying to work out some sort of deal financially here. And again, loss given default is going to be some sort of percentage. Like, we're not going to collect maybe the whole amount. We're going to take some sort of loss on that. So to get the expected loss, the whole formula here, it's going to be that probability of default. So the likelihood you will default, and then times that loss given default percentage times that exposure at default, which is going to be that dollar sign here. And this will give you a dollar loss. Now, this is how banks model losses. Why are we talking losses here? Like, I'm acting this is everything. One, you can back profitability out of losses. And two, we do what are called scorecards, which I didn't put in this presentation. But you can build out credit scorecards, which actually rank order your customers by riskiness, and often that's done by probability of default. You can even use like an expected loss percentage. You can convert things around. But PD, so probability of default, is really commonly used here, where it ranks your customers from riskiest to safest. That's what FICO is. FICO is just a probability of default model. Again, it ranks them where I think like 350 is the lowest score. And then I think it's like, 900 is the highest score here. 900 means your probability of default is like 0. 350 is like 1. And then as you look at, different scales in the middle of there, you're going to have different kind of scores here or probabilities of default. Now let's talk about the complexities a little bit here. There is two types of time here inside of loans, which makes this far more complicated than other things like equity. So again, you think of things like equity, right? There's time, there's calendar time, which is going to be things that are driven by like macroeconomic drivers, like unemployment spikes and CPI, the inflation rates are bouncing all over the place. And we have all these issues, and that's going to drive the profitability of a firm, right? That impacts loans as well, in the sense that on calendar time, like if unemployment rates spike, we expect now losses for all of our loans are going to go up. We're going to have a significantly riskier position here, because now a lot of our customers are going to be unemployed, which is what the unemployment rate is measuring here. So these things impact it. We don't even consider this at most banks, though, because calendar time is challenging to incorporate into loan portfolios here. We look at what I like to call vintage time. So you issue a bunch of loans. They have a vintage here, which I'm going to show you here in a second. This is what a vintage curve looks like. This is way too smooth for a real vintage curve, but got to make something up to show you guys. Vintage curves kind of show the losses across time here. So this is a loss vintage curve. So on the bottom here, you have months. So I'm just pretending this is a 5-year loan, because that's what we've been talking about here. And say we have this big portfolio of loans. We had a bunch of 5-year loans on January 2023. This is how you know this is not real data, because a 5-year loan would mature in 2027. So I wouldn't have this data on here. But what you do is you cumulatively add up all of your losses across time on the portfolio. And as that portfolio goes on, so let's say it's 100 loans, for example, as more and more loans default, you will calculate your losses across time here, the vintage time. These curves, though, the vintage itself, we track vintages. Vintages just means the date that it was originated. So this is a January 2023 vintage. If you made some in February, you could have a February 2023 vintage. But often we look at vintage curves based on term. So this could be a 5-year vintage curve. Now, this starts to get confusing, because you can look at vintages in different perspectives here. But loans we look at and say, okay, on an average portfolio of loans, or on an average loan here, let's say in this example, I don't know, we're peaking out probably on about 15 months here, 14 to 15 months. That's when the curve starts flattening out. So you can look at and read vintage curves. Again, based on different characteristics and things, you can kind of figure these out, and you get kind of a feeling for it in the industry. But let's say about 15 months here, we start to see things, flatten out. That means we need to survive losses, and we're going to expect, at month 15, we're going to be looking at, I don't know, about 26 and a half, probably 26% loss rate at the 16th month. We're only going to cap out to 30 here. And what this is saying is we're like, I don't know, by the time you hit like month 26, 27 in here, we're done. We're going to be capped out at 30. Most of the risky loans are going to have fallen off. So those high risk loans that defaulted at the beginning, those are all gone. And we should see pretty smooth sailing where our loss rate now is just going to stay flat around 30%, give or take. We'll probably see a little bit of movement here and there. But this is what a vintage curve is. This is how we consider and look at loans and timing. Is it's based on the timeline or the term of that loan. So is it 1 month old, 2 month old, 3 month old, right? All out to 60 months. That's the one time frame. But we don't typically look at calendar time. We look at vintage time. Now, when you start stacking vintages across time, you have all these cash flows coming in. There's a bit of diversity in that sense. And we like to expect that loans are going to come in a specific time frame here, and they're going to have specific returns. And we know exactly what we're doing. But the thing is that banks and financial institutions, we end up having to refit and rebuild models about every year to 2 years here. Now, most firms are doing about annually. They do like a refresh, for example. And it's because the macroeconomic drivers are moving. The economy is changing. But our model doesn't typically fit that. When we looked at expected loss modeling here, the 3 pieces, there's no time, right? Time isn't baked into this. All I'm looking at is loans on a specific sort of term here or whatnot. And I'm trying to figure out what's the likelihood they're going to default based on customer attributes here. Combining these sorts of things gets complicated and the problems get way out of hand. And so this is one of the complexities, is how do you incorporate both of them? Now, there's something called DTD, which is dual time dynamics. I think Joe Breeden's the inventor of this. Did a little bit of documentation for them at one of the banks. And this incorporates these vintage curves, and then it overlays on top of this macroeconomic impacts and effects using stochastic processes here. That's how you do the estimation process. It's a little bit complex, but you have this nice smooth curve, and then you're going to have sharp kind of jagged bounces around it, which is going to be the economic drivers, which are going to show you more or less what you should expect for losses given vintage and calendar time together. It's okay. I don't think it solves everything. It's okay. There are other ways to do this. There are other complexities you can add into this, as we've kind of talked about throughout the presentation here. CCAR, for example. So I have CECL, CCAR, and daily business. These are different types of usages. For a bank running a daily business, I just don't care about, macroeconomic effects. They typically do this on a higher level risk management perspective, looking at rates. If rates are going to be rising, how do we manage that? And then you kind of back into the fact of where the portfolio and positions are going to be going. And then strategically, how are we going to position pricing, which I'll show you here in a second, of these loans so that we don't lose money going forward here. Other uses like CCAR, that's the Comprehensive Capital Assessment and Review, which came out of the whole Dodd-Frank thing in 2010. Again, you have to do stress testing. So at this case, we don't care about vintage time anymore. All we care about is modeling our losses across time with impacts from macroeconomic drivers here. And then you're just going to plot all these out. Again, we don't care now about the loan level. All we care about is going to be the macro portfolio level. And so for CCAR, we do this sort of stress testing to show kind of where we're going to be at, but we're not decisioning off of this like we would on a daily business case here. Something more like CECL, we're just kind of using our traditional expected loss models. So I have SARIMAX listed here. This is very common for CCAR. So SARIMAX is my umbrella to catch any possible exogenous ARIMA style model with autoregressive model, moving average model, AR, autoregressive integrated moving average, like any combination of that falls in this kind of SARIMAX structure here. Those are typically used for doing CCAR modeling. The other complications and things to think about is what drives loan performance, right? Now, this could be a macroeconomic factor like we kind of hinted at, but it's typically not. It's typically going to be consumer specific information here. So, how many loans have you defaulted on in the last 90 days? What is your utilization rate for your credit here? So revolving credit is like credit cards, short-term credit that you can revolve. Those sorts of things, like I talked about in one of the past videos on getting credit cards. Again, there's all this data and personal information on income and payments and amount and debt. So DTI is debt to income, for example. There's all these things we look at, and there's thousands of these variables that the bureaus track. And so what ends up happening is banks go out and they purchase all this data, which is extremely expensive. And then as customers come through the door, we have to send out a credit request so that, that hard check on your credit score. We have to send out this request to these bureau agencies, and then they send us all this data back on you, and these go into the models that we drive to see if you're going to be likely to default on a model. And then we look at things like what's going to impact the collections and LGD and EAD, for example, here. So you need a lot of these different variables and drivers to figure it out. These models can be very, very complicated. They can be super simplified. Again, it depends what you need and what you're doing and kind of what markets you're in. And then on top of that, you have origination and strategy bias here. There is another term for this. I cannot think of it off the top of my head. An old boss of mine used to just pound it into us, and I can't even think of it anymore. But essentially, like a institution is going to have some sort of market they're going to target here. So maybe they do, near prime to prime, which is kind of the middle part. Because you have subprime, you have near prime, then you have prime, and you have super prime. It's kind of the four main categories here. A bank is going to target specific markets here. So some banks are only going to do super prime. They want really, really safe loans here. But let's say you do a super prime portfolio here. You're going to have an origination or strategy bias in the sense that your data is only going to be on those super prime customers. If you ever want to do loans that are like in the prime range now that are next to you, you don't have data for that. There's no way to get that. You have to there's a whole process of buying data, and it's expensive. And then even when you purchase data, you don't know if those customers would have chosen to go with your bank, right? When you go get a loan, you typically get offers from a couple different places. There's a whole modeling structure called reject inference, which I've done before, and you're trying to essentially use a model to assess the likelihood that they would have made the decision to go with you, and then looking at the actual performance of these loans to figure out if these are going to be profitable or not, given some sort of model here. So reject inference is a whole other analytical tool set with modeling involved. If you're interested in that, you can look that up as well. But that is another piece here where quantitative finance really comes in handy, because when you start to expand into other markets here, it gets a lot more complicated of, who's going to actually accept you, who's going to reject you. And that leads us into the second complexities here, which is going to be pricing strategy and pricing. So everybody has asked me, say, Dimitri, economics has no relation to quant finance. And it has everything to do with quant finance. And this is just going to be an example of it, which is going to be supply and demand. So you think about banks that are competing for loans. So we've been talking a lot about auto loans here. Let's say we're competing for that prime market here. Who are the big players? It's going to be like Bank of America, Wells Fargo, JP Morgan Chase, right? It's gonna be these big, safe players in this market here. Again, you can't just price loans and say, okay, the expected loss is X amount. We want to make 10%. This is going to be our price. We're done. That's not how simple it works. One, you have to have all the models to build all that out, to figure out the losses and do all that calculation. But then you still have supply and demand on the pricing side of this, which is, maybe JP Morgan knows my target rate's 10%. They come in at 9.5. They're going to undercut me on every single loan. Again, pricing is going to come in the fact of rates. So what is your interest rate on the loan? This is why different customers get different rates. Because depending if you're really risky and you're in a default early, I need a lot of interest to help cover that, so that my break-even point on that loan is going to be much closer to origination compared to somebody who is extremely safe. You might be able to give them like a 0.5%, 1%. Well, back in the day, a few years ago, and inflation and the economy didn't go to crap, but before interest rates hit their big run here, a really safe customer might get 1%. You might have those like steals like during the holidays where it's like a 0% APR. They're having to predict out that you're going to make the payment to the very end to break even, or they're going to have to make sure that when they sell the vehicle for enough money over what they actually paid for that vehicle, so they have enough profit on there to cover that. So there's profit in the sell of the vehicle as well, which is a whole other piece of this. But we're not covering that today. We're just talking about loans. And so you have pricing and you have rates. There's also things called origination models. So banks don't accept every loan that comes through the door, right? If I'm only doing prime or super prime, for example, you're going to have some sort of score like a FICO, and you might say, I'm not accepting anybody less than 750 because we're going to do super prime. Or maybe 800 or something ridiculous here. So you have to have criteria for acceptance or rejectance. The other piece I don't even have listed here is going to be fraud models. So customers steal social security numbers, they steal information, they lie on income. They do all these sorts of things, and they make fake loans, and then the car disappears and they run with the car. This is fraud, right? You made a loan, you never made payments, or you made one or two payments, and then you disappear. Again, you need models to protect firms from fraud. Those are fraud models. You need origination models here to do actual acceptance and rejectance here at a traditional bank, because traditional banks make an acceptance or rejectance based on the criteria of their programs and setups and a whole bunch of different criteria here, looking at those loss models, for example, figuring out if it's going to be profitable or not. And then on top of that, there's all this pricing strategy, as I'm kind of mentioning here too. And a lot of this at most firms is not even model driven, though I think it should be. But they're going to look at things like, okay, if we tighten up credit policy, so recently the economy's gone to crap in the last, 12 months here. A lot of the banks have tightened credit policy. Now, what this means is that, say you had a FICO score of, let's say we used to make loans from 600 and above. When a bank tightens up, they might say, okay, now we're going to make them from 700 and above, right? You're reducing risk because now you're only getting safer customers. Well, there's other things you have to consider. For example, you lose volume now, right? All those loans that you were making in volume, that supply and demand piece, you're going to just cut volume out. You're not going to be able to all of a sudden find a bunch of extra customers now in your 700 plus range. And then on top of that, if every bank is doing the same thing, they're all tightening credit policy here, that market at the top is getting more and more competitive. And as it gets more competitive, you're going to make even less volume. So there's a lot of modeling and analytics that goes in behind the scenes on these sorts of things with loans. This is why there's entire pricing teams at firms usually, or they call decision sciences. They're playing with these things. They're looking at models. They're doing analytics, trying to come up with some sort of solution on how we can make money without losing money. How do we compete with the other banks? And competition is always good because it helps drive those rates down so that customers are getting good rates. So that's why I highly recommend, if you're going to get a loan, go to a few different banks, because different banks are going to have different models. And, that model might be super accurate for one person and really not accurate for another person. Now, you could benefit from that. So if the model's really inaccurate and it gives you a great price, that's where you're going to want to go. Now, you might get the other side where the model's really inaccurate and someone gives you a crazy high price. Don't go with them. Just find another bank that gives you a better price because they have better models and better pricing strategy. So anyways, this is kind of my presentation here on loans. This is how loans work in a very, this is like executive high level. These are some of the areas we use models in, like in pricing and losses and strategy and reject inference. And there's a bunch of analytics that goes in behind the scenes on top of actually modeling. So looking at things like, if I do this, then this might happen. And you might do some sort of analysis, like if this and that, or A/B testing things. That's analytics, not modeling. But this is how loans work. This is a lot of the complexities behind it. This is an entire industry. So like the mortgage market is trillions of dollars. Auto is definitely in the billions. They might be close to a trillion as well. But that is how loans work. So if you enjoyed this video and you found it helpful, don't forget to like, share, and subscribe. And as always, until next time.